When a citizen deposits a single rupee into a local bank, it triggers a chain reaction across a mechanical system. The currency is multiplied by commercial banks, throttled by the Reserve Bank of India, and eventually flows across international borders into foreign exchange markets. For candidates approaching the APPSC Group 1 and 2 exams, success depends on moving past static definitions. These exams test the mechanical linkages and the specific regulatory rules that govern how these different components interact. We are mapping this system by progressing chronologically through sections 2.2 to 2.30 of the syllabus. We will trace the life cycle of money from basic household deposits to the creation of the national money supply, moving through the RBI's quantitative controls to the macroeconomic borders. Understanding this sequence in order reveals the logical flow of the entire system, making it possible to identify the specific errors in APPSC trick questions. Money serves three foundational roles: a medium of exchange, a unit of account, and a store value. The value of this currency is managed through exchange rate systems, ranging from fixed rates to the market-influenced managed floats. This timeline illustrates how the government borrows capital. The primary distinction is time. Short-term borrowing, maturing in under 1 year, utilizes treasury bills or T-bills. Long-term borrowing, which can extend up to 40 years, relies on dated securities that pay periodic interest. The government also issues special securities, such as oil or fertilizer bonds, to compensate specific entities in place of cash subsidies. These are restricted instruments. They are issued directly to those specific corporations and are not available to the general public. This time-to-maturity logic separates the markets as well. Instruments maturing in under 1 year trade in the money market, while those requiring more than 1 year trade in the capital market. At the banking level, liquidity is defined by account type. Demand deposits, like current and savings accounts, are accessible instantly. Time deposits, such as fixed or recurring deposits, require the money to remain for a specific period, trading immediate liquidity for higher interest. Across every financial instrument and market, the time to maturity serves as the primary axis determining both risk and liquidity for the entire economy. This funnel represents the liquidity levels of the economy, categorized from M1 to M4. M1 is the most liquid, consisting of physical currency and demand deposits. As we move down to M4, we include time deposits and post office savings, which take longer to convert to cash. While M1 and M2 are narrow money, the RBI utilizes M3 as its primary measure of the money supply, officially calling it aggregate monetary resources. This money supply is expanded through commercial banking. When a bank receives a 100 rupee deposit, it places a required percentage into a reserve vault and lends out the remainder. This loan eventually becomes a new deposit elsewhere, mathematically expanding the initial sum. The scale of this multiplication is dictated by the reserve deposit ratio set by the RBI and the currency deposit ratio of the public. If citizens choose to hold cash rather than deposit it, the bank has less capital to lend, and the expansion of the money supply slows. While the government prints physical notes, the total volume of money in the economy grows through the combined behavior of public deposits and bank lending. To manage this expansion, the RBI uses specific quantitative controls. The cash reserve ratio requires banks to keep a set percentage of deposits as cash with the RBI. The statutory liquidity ratio, or SLR, requires banks to maintain a separate reserve in the form of cash, gold, or government securities. This table highlights two frequently confused rates. The repo rate is the short-term interest rate for lending to banks, and it requires government securities as collateral. The bank rate is for long-term lending and does not require collateral. The RBI also manages durable liquidity through open market operations. To reduce inflation, the RBI sells government securities to banks to absorb their cash. To increase the money supply, the RBI buys those securities back, injecting cash into the banking system. The central bank generates income from these operations through seigniorage, the profit on currency production, and the inflation tax, which occurs as inflation reduces the real value of the currency the public holds, thereby lowering the RBI's liabilities. By adjusting these dials, reserve ratios, lending rates, and market operations, the RBI can flood the system with liquidity or starve it to control inflation. This flowchart tracks the history of interest rate transmission. Banks were once slow to pass RBI rate cuts to consumers, using internal metrics like the base rate and MCLR. To force faster transmission, the RBI mandated the external benchmark rate, which links loan interest directly to external markers like the repo rate. This rapid lending requires structural safety. The international Basel norms ensure banks maintain enough capital to cover the risks associated with the loans they issue. If a bank's financial health weakens, the RBI initiates prompt corrective action, or PCA. This framework imposes immediate restrictions if a bank breaches set thresholds for its capital levels, its asset quality, specifically non-performing loans, or its overall leverage. Certain banks are so large that their failure would destabilize the entire economy. These systemically important financial institutions are required to hold higher capital buffers because they are considered too critical to the system to fail. The RBI's tools can only function if the commercial banking system is structurally stable and has mechanisms to transmit interest rates directly to the public. This domestic system operates within a global framework. Foreign investment is categorized by ownership level. An investment of 10% or more in a company's equity is foreign direct investment. Anything below that 10% mark is foreign portfolio investment. This diagram of the balance of payments shows how a country tracks its global transactions. It is divided into the current account and the capital account. The distinction is precise. The exchange of goods and services, and transfers like remittances, belong strictly to the current account. The capital account records changes in asset ownership, including foreign investments, commercial borrowings, and banking capital. This graph represents a liquidity trap. Even if the central bank lowers interest rates to zero to encourage spending, a public that fears a recession will simply hoard cash, making further interest rate cuts ineffective. Policymakers also manage the Phillips curve, which shows a short-term inverse relationship between inflation and unemployment. When a growing economy adds jobs, the resulting increase in demand typically pushes inflation higher. Every domestic policy decision by the RBI is eventually bounded by these global trade balances and macroeconomic realities. We have tracked the architecture of the system from a single deposit through the M3 money supply to the RBI's quantitative controls and out to the international borders. This shows the direct cause and effect chain. RBI rates influence the money multiplier, which is limited by bank stability and impacted by international capital flows. When answering exam questions, view these sections as connected parts of one system. A change in open market operations has a direct traceable impact on M3 liquidity and eventually the inflation rate. Mapping the syllabus in this sequence provides a functional model of the economy, allowing you to logically determine the answer to any complex macroeconomic question.